Welcome to the Good Life Club, where we unravel the intricacies of personal finance. Today we're diving deep into the age-old question, Roth IRA or traditional 401k. Don't miss out on this financial insight. It's your ticket to securing a comfortable future. In the realm of personal finance, one question often looms large. Where should you invest your hard-earned money for retirement? Roth IRA or traditional 401k? Let's break down these options and discover the path to financial success. Roth IRA, the power of tax-free growth. Let's start with a Roth IRA, a formidable contender in the world of retirement savings. This investment vehicle allows you to contribute up to $6,000 annually with post-tax dollars. The real magic happens after you reach the age of 59 and a half. You can withdraw both your contributions and the earnings completely tax-free. Here's why the Roth IRA shines. 1. Tax-free earnings. The profits you make in a Roth IRA are entirely tax-free after reaching the magic age of 59 and a half. This translates into substantial savings in the long run. 2. Flexible contributions. Need to access your contributions in a pinch? No problem. With a Roth IRA, you can withdraw your initial contributions anytime without penalties or taxes. Earnings, however, must remain in the account. 3. Consistent growth. Enjoy the benefits of compounded growth over decades, free from the burden of taxation. However, it's essential to consider the drawbacks. 1. Post-tax contributions. Contributing post-tax dollars means you initially have less money to invest. Your contributions won't lower your current tax bill. 2. Penalties for early withdrawal. Withdraw earnings before reaching 59 and a half and you'll face a 10% penalty along with income taxes. 3. Contribution limits. Roth IRAs have a capped annual contribution limit of $6,000, which may not be sufficient for some investors. Traditional 401k, tax-deferred growth. Now let's turn our attention to the traditional 401k, an employer-sponsored retirement plan that enables you to invest pre-tax income. By doing so, you can delay paying taxes on your contributions until withdrawal, usually after the age of 59 and a half. Here's why the traditional 401k deserves your consideration. 1. Immediate tax savings. Contributions to a traditional 401k are made with pre-tax dollars, effectively lowering your current taxable income. For instance, if you're in a 32% tax bracket and contribute $19,000, you save $6,080 in taxes. 2. Generous contribution limits. The annual contribution limit for a 401k is $19,000. More than 3 times that of a Roth IRA, allowing you to supercharge your retirement savings. 3. Employer match. Some employers offer matching contributions to your 401k. It's essentially free money, an unmatched opportunity for substantial returns. However, there are potential downsides. 1. Deferred taxes. While you save on taxes today, you'll eventually pay taxes on your 401k withdrawals after the age of 59 and a half. This strategy works best if you anticipate being in a lower tax bracket during retirement. 2. Early withdrawal penalties. Accessing your 401k funds before the age of 59 and a half for non-hardship reasons incurs a 10% penalty plus ordinary income tax. 3. Mandatory withdrawals. You'll be required to start withdrawing funds from your 401k at 70 and a half, which can limit your ability to let your investments grow. Choosing the right path for you. Now, which path should you follow? The answer hinges on your current financial situation and your future outlook. Here are some guidelines to help you make an informed decision. 1. Roth IRA. Opt for a Roth if you're young, in a lower tax bracket and anticipate higher earnings in the future. Your tax-free withdrawals will pay off handsomely over time. 2. Traditional 401k. Consider a traditional 401k if you're currently in a high tax bracket and expect a lower one during retirement. The immediate tax savings can fuel your investments. 3. A balanced approach. Striking a balance between both options is a prudent strategy. This approach allows you to hedge your bets and maximize tax advantages while securing your financial future. The unpredictable tax landscape. One important factor to remember is that the tax landscape can change significantly over several decades. Tax rates may rise or fall, making it challenging to predict the most advantageous option. Thus, diversifying between a Roth IRA and a traditional 401k can offer a measure of security in an uncertain financial world. Employee contributions to 401k. Now, let's delve deeper into the mechanics of 401k contributions. When you contribute to a 401k, you're essentially reducing your taxable income for that year by the contribution amount. Here's an example to illustrate the concept. Suppose an employee earns a $50,000 salary and contributes $10,000 to their 401k. In this scenario, their taxable income for the year would decrease to $40,000, all else being equal. For the year 2023, participants can contribute up to $22,500 annually to either Roth or a traditional 401k. Individuals aged 50 and older have the opportunity to make an additional catch-up contribution of $7,500, further bolstering their retirement savings. Employer matching contributions. Employer matching contributions are a compelling reason to participate in a 401k. Employers often match a percentage of their employees' contributions, typically up to a specific limit or percentage of the employee's salary. Let's break down how this works. For instance, an employer might decide to match 50% of an employee's contribution, but only up to 6% of the employee's salary. If the employee contributes 6% of the salary, the employer would contribute a matching 3%. However, some employers may outline a matching policy that adheres to IRS limitations. For example, a company might offer a 50% match on all 401k contributions, but not beyond the contribution limits. In this case, the maximum employer match in 2023 would be $11,250, 50% of $22,500. It's important to note that if an employee contributes less than the specified percentage or amount, they might not qualify for the employer match or receive a reduced contribution from the employer. Reviewing the 401k plan documents is crucial to understanding the specifics of the employer match, including the maximum match and the minimum employee contribution required for eligibility. The IRS sets limits on total contributions, both by the employee and the employer, to a 401k account. In 2023, these contributions cannot exceed $66,000 or $73,500 with catch-up contributions. Additionally, the total contribution to a 401k cannot surpass 100% of the participant's compensation. Withdrawals from 401ks. Withdrawing funds from a 401k is a significant aspect of retirement planning. Withdrawals are taxed at the individual's income tax rate. Importantly, there's no penalty for withdrawals as long as they're made at the age of 59.5 or older, ensuring that you can access your hard-earned savings in retirement without incurring additional charges. Individual retirement accounts, or IRAs, are versatile retirement savings vehicles established by individuals. These accounts can be held by banks, brokerages, and investment firms, providing a range of investment options. Here's what you need to know about IRAs. IRA contribution limits. Annual contribution limits for traditional and Roth IRAs stood at $6,000 in 2022, with an additional catch-up contribution of $1,000 allowed for individuals aged 50 and older. However, the limits for 2023 have increased, enabling individuals to contribute up to $6,500 with an additional catch-up contribution of $1,000 for those aged 50 and over. traditional and Roth IRAs. Much like 401ks, contributions to traditional IRAs are typically tax-deductible. Earnings and returns within the account grow tax-free, with taxes paid upon withdrawals in retirement. In contrast, Roth IRA contributions are made with after-tax dollars, resulting in no tax deduction at the time of contribution. However, qualified distributions from a Roth IRA are tax-free during retirement. IRA benefits. One of the primary benefits of IRAs is their wide array of investment choices. IRAs held by brokerage and investment firms offer investors greater flexibility, allowing them to invest in stocks, bonds, CDs, and even real estate. However, certain assets such as art are not permitted within an IRA as per IRS regulations. Moreover, employer plans generally provide some level of matching contribution for those with an income below a specific threshold and no coverage by an employer plan, contributing up to $6,500 per year, along with a $1,000 catch-up contribution for individuals aged 50 and over, is feasible. When comparing 401ks and IRAs, it's essential to consider the range of investment choices and the associated costs, which can vary depending on your investment selections. Withdrawals from IRAs. Similar to 401k plans, IRA holders can begin withdrawals once they reach the age of 59.5 without incurring a tax penalty. However, withdrawals before this age may trigger a 10% tax penalty unless they qualify for a hardship withdrawal. Notably, unlike 401k plans, IRAs do not allow borrowing against the account's balance. SEP and simple IRAs, simplified employee pension, and savings incentive match plan for employees' IRAs are retirement accounts offered by employers to their employees. While these accounts share some similarities with 401ks, there are notable differences, primarily in their contribution limits. SEP IRAs come with higher annual contribution limits compared to standard IRAs. Only employers can contribute to SEP IRAs, with contributions potentially reaching up to 25% of an employee's gross annual salary, provided they do not exceed specific limits. In 2022, the annual contribution limit was $61,000, or $67,500 for those aged 50 and older, and in 2023, it increased to $66,000, or $73,500 for those aged 50 and older. One significant advantage of SEP and simple IRAs is that they are typically 100% vested immediately after the employer's contribution is made, offering employees full ownership of these contributions. Simple IRAs contributions function differently from SEP IRAs and 401ks. Employers can choose between either matching up to 3% of an employee's annual contribution or establishing a non-elective 2% contribution of each employee's salary without requiring employee contributions. In 2022, the contribution limit for employees was $14,000, and in 2023, it increased to $15,500. Individuals aged 50 and over had the opportunity to make an additional catch-up contribution of up to $3,000 in 2022 and $3,500 in 2023. Can you lose money in an IRA? Yes, it is possible to lose money in an IRA. IRAs typically invest in securities like mutual funds or stocks, which can fluctuate in value. Just like any other investment account, an IRA is subject to market risks. Can you roll a 401k into an IRA penalty-free? The IRS allows for the rollover or transfer of funds from a 401k to an IRA. However, it's crucial to follow the IRS guidelines to ensure that the transfer doesn't count as a distribution, potentially incurring a penalty. Conducting a direct rollover is the simplest way to ensure that funds roll over penalty-free. With this comprehensive understanding of retirement accounts, it's time to evaluate your own financial situation and plan for a secure retirement. Whether you choose a 401k, an IRA, or a combination of both, remember that investing in your future is one of the best decisions you can make. Your golden years are waiting. Start planning today. Thank you for joining us at the Good Life Club, where we empower you with the knowledge you need to make informed financial decisions. Until next time, stay financially savvy, and here's to a prosperous retirement. Don't forget to like and subscribe for more expert insights on managing your money wisely and live your best life.